Hello, I'm Greg Bonnell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that boost your trading potential. Coming up, markets trading higher this morning following two back-to-back down sessions, and now we got gold and silver pulling back from recent highs. What's an investor supposed to do? How do you navigate this market? Diana Avigdor from Barometer Capital is going to join us to explore where opportunities are emerging and how tactical investors can balance risk amid these volatile conditions. Plus, we got Bitcoin down a little bit right now, but it's been climbing this week, closing in on that psychological 100,000 level. In today's technical take, we're going to take a closer look at the charts to see what they say about this renewed momentum in crypto. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour into the trading day. Let's check in on the S&P 500. We do have a rebound on our hands after a couple of down sessions being led by the chip sector. That's a nice thing to see. And in this part of the world, it's pretty cold. It's pretty snowy. So a little green on the screen is going to put a smile on my face. Let's jump into the heat map and see what is putting that green on the screen. We got NVIDIA, Apple, Broadcom, AMD, Cisco, IBM. I'm rattling off a whole bunch of tech names, namely AI names that have gotten a nice strong run over the past year and a half on a lot of excitement, are showing a little bit of strength. Apple's sort of flat. Let's take into Taiwan Semiconductor, though. Where's the excitement coming from? Posting another record quarter, a 35% increase in their fourth quarter profit. They beat estimates. The demand for their AI chips is very, very robust. Powering these earnings, also as a part of these earnings, talking about how much more money they're going to spend. And of course, that has other companies in the universe who supply them and who depend on them also getting a boost today. I want to check in on BlackRock because, of course, it was the topic of our bear bull debate on Tuesday's show. The world's largest asset manager reporting earnings and revenue that topped expectations. This number stands out. They pulled in $342 billion of client cash in the fourth quarter. That pushed the firm to a record $14 trillion of assets under management. So we got some upward movement in BlackRock at the open. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing educational team. And from Toronto, we're joined by Diana Avigdor, head of trading with Barometer Capital. Before we dive in, I just want to remind our viewers the views and forecasts expressed are solely those of Diana and her team at Barometer and based on their research. Diana, interesting equity market environment so far in 2026. We're saying off the top, now we got a rebound in equities, we got a pullback in gold and silver. How can a tactical investor start to navigate a market like this?
Indeed, you have to step back a little bit from the day-to-day, and our job is to understand the kind of structural underlying themes that are driving the market. Now, the stock market didn't know that it was December 31st, so it didn't realize it's a new year. So for it, it's just a continuation of the same kind of thing that happened in 2025, which is markets continue to reflect an early stage broadening bull market driven by expanding participation rather than narrow leadership. Headline indices like S&P and NASDAQ 100 remain constructive and making new highs, but equal weight measures are outperforming here in the short term, signaling that the average stock is doing better than the largest names. That's not to say that the largest names cannot ebb and flow, and they've been kind of sleepy in the last little while. Maybe they recover in their momentum, but for the first time in many, many years, and this includes 2025 and 26 and continuing in this vein, for the first time in many years, true portfolio diversification is working. As you have many other markets participating, you've seen Canada outperform the U.S. last year. Again, that's not to say that the U.S. Wasn't up. It was up 16%, 18% with all-in dividends. Canada outperformed. Europe outperformed. We have positive moves out of Asia, and now emerging markets seems to be very positive in people's minds. So true diversification of portfolios, not only geographically, but also style. So what used to work is only momentum and growth, and value was left to left alone for the longest time. Value remained value constantly and did not move. Now you have valuation dispersions, and the sectors that are working are allowing for investors to diversify on the style side in their portfolios too, which not many people talk about. I think it's important you can have your growth and you can have your value in your portfolio and diversify geographically, and it feels better than just having all your eggs in one basket, which is what worked.
Well, yeah, it worked for a long time. I want to talk about that because you mentioned Canada in there a few times. Of course, you and your team are tactical investors. These sectors and themes you're starting to lay out for us. Can Canada play a role in that? I'm wondering about outperformance again for this year for the TSX.
Absolutely. So what we think is just in the beginning of a cycle is, of course, a commodity cycle. We've seen gold and silver do what they're doing, making new highs. And the fact that they're down a little bit today, that's actually a good thing because they're really, really far away from their moving averages. We've seen copper act the same way, and energy is down today on subsiding geopolitical angst, but the companies are doing very well. The Canadian energy companies are very fiscally disciplined now. They pay back in dividends and they buy back shares, and so they're acting very well, and they're acting better than the actual commodity. Their cost of production is low, and the administration over in the U.S. has triggered some navel gazing, is what I call it, in Canada. And I don't know what's going to happen in the next 10 years, but I'm suspecting that perhaps we're going to be looking to eke out productivity and better ways to do business in Canada, given what's going on with our neighbor.
Diana, let me ask you, because we were just talking a moment ago about diversification. It's known as the only free lunch in the market. So where do you see, you talked about Europe, you talked about Asia, where do you see the opportunity for diversification beyond our borders and asset types for 2026?
So the reason international markets are working now, Europe, for example, is one of those markets that I think that people should have exposure to. And the reason it's working is because Europe, like Canada, is value, commodity driven markets. And those are the sectors that are working globally. So the way I look at the world is go to the market that specializes in what you want exposure to. Go to the US for AI, growth, and technology, and go to Canada, Europe for value, commodity. Now, financials, interestingly enough, financials are kind of working everywhere. Europe's financials were much cheaper than say Canadian financials, even though Canada's banks have a bit of a monopoly on our market. There's only a few of them. So financials across the globe, we have exposure to. We diversify that globally.
Okay. And let's talk about what's topical right now. You know, Greg mentioned at the top that TSM just released earnings. It's buoyed up a lot of those AI plays there. We had Ed Yardani with us a couple of weeks ago on the show, and he mentioned, you know, he's of the view that most of these companies are now AI plays or AI adjacent. So speaking specifically within the tech space itself, where do you see the next wave of growth? Is it automation? Is it still pure play AI, or is it those AI adjacent sort of names?
I think it'll all work to a different degree. So I don't think NVIDIA goes down and automation goes up. I think that in different degrees, they will all work. You have to pick your spots. Some of the things that AI may hurt is perhaps, you know, software or cybersecurity. But the derivatives of the AI development, like automation and robotics, companies that will really benefit from this. And of course, we're seeing the chips working really well. That is something that is going to be in demand forever. Everybody talking about the hyperscaler CapEx. Well, Taiwan Semi has announced CapEx much higher than the street was expecting, and that is actually pulling the whole space up. I think we're going to ebb and flow. I understand that given how much these stocks have rallied, it's a natural tendency to think it's too much. And at some point, it will be enough. And the hyperscaler CapEx growth, the growth is slowing, not the actual spending. Spending's going up, it's just the growth rate is going down. But I think that there is a little bit more room to go before it all stops. And robotics, there's so much there, whether it's in cars, whether it's, in the home. And by the way, we just mentioned financials. Financials stand to benefit a lot from AI developments. And this plays into the macro, and this has been a Canadian talking point, productivity, which is very hard to measure, but I think that all plays in together into this heat map.
Yeah, let's talk about that productivity, because I think that the discussion, obviously, if we're talking about a broadening of the markets, and it's not just going to be the AI plays, but even in the AI trade, I feel like there's a broadening that we want to happen. We want AI to make us more productive. We want it to make companies more profitable. Is 2026 the year that happens?
Yes, I think it starts. I think this is a longer process. I think companies and people will have their times of bottleneck or stress. We can bring in what it does to the labor market and so forth. But I think it does work its way through. So companies will have to figure out how and when they benefit from it, what they're taking on, what they're doing with people. And people need to perhaps retool. Labor market retools. A lot of things kind of play into this. One of the knocks on AI is that it's going to hurt the labor market. And my answer to that is that the labor market will retool. Not only that, we do have a bit of a demographic issue going on in developed markets. There is more older population than younger population. And there is less numbers having to come into the workforce to actually hold the unemployment rate where it is, without, the labor force basically is getting a little smaller as we go along in this demographic story. So it's all not going to happen in 26, but I think that this is the next theme of our next generation.
Is it too early at this point, Diane, to start thinking about specific sectors that are going to benefit from the retooling and the labor force adjustments?
We love financials for this reason. We love the companies that do automation and robotics. So I think that those are the main two sectors that will benefit from this initially, anyway.
Gives me flashbacks of the Jetsons back in the day, Diana, having robots manage your home there. But we're going to turn the tale a little bit on its head now. We're going to talk about technicals, because you've been pretty vocal about saying in the past that 5% equity drawdown at any time is just part of this market. And I tend to agree. In a healthy bullish market, you want to have some of that pressure release and have those sort of pullbacks, I want to call it. I'm surprised you didn't say a correction, which would be the technical term, 10% down. But what I wanted to ask you was, how high is the risk of a, let's say, a correction or a pullback, if you want to call it 5%, in the first half of this year, especially with volatility being pretty muted, I would say, even through end of last year and coming into this year? VIX hasn't moved up. And what technical signals are you watching to confirm it?
So for us at Barometer, the main thing that we watch are breadth indicators, breadth expanding, breadth declining. Right now, it's looking pretty good. And it's, we look at this on a daily basis. There is, of course, the technicals that everybody's watching, which is where the market is relative to its 50-day and 200-day moving average for support. I really love that you brought up the volatility. VIX is I'm looking at it. It's probably around 1560 right now,
Yeah.
down 6.8% this very moment. It's been low the whole time, mainly because the realized vol has been pretty low, mainly because everybody's on the same side of the trade, which, yeah, that doesn't sound great. But portfolio insurance is pretty cheap right now. So, but it hasn't really done anything for us. Thankfully, this is buying insurance is a trade that you want to lose on. Now, to your point, can the market come in 5%? Absolutely. Can the market rotate back to old favorites? Say, take the Mag 7 up and have gold and silver and copper come down? Absolutely. But you want to step back. That's when you want to step back and you want to look at whether it holds support and you try to put in your bids around there. And then there's nothing wrong with putting in a bid at around support level and making sure that your stop losses or the level where you would exit that trade is right below it. One of our main roles that we feel for our clients is to make sure that mistakes are not big mistakes. And so it's much harder to be a disciplined seller. It's much harder to manage risk than it is to buy a company that you believe in and have it go up and then figuring out where your target price is. That's kind of an easy trade. The hard trade is to be disciplined. If the market turns down, where do you have your stop losses? How do you handle your protection? And like I said, you try your levels, you put in your bids, but make sure that you know how much you're willing to lose if that turns back. We're very, very big on having the market and our stocks prices confirm what we think. So if we think that robotics is the place to be, or if we think that financials is the place to be, and we have, whatever banks in our portfolios, those banks have to act the way the narrative asks for.
So Diana, we put that together and the work that you're doing in terms of, I like the idea of being the disciplined seller because I've always found that difficult. We put together the way you approach the markets with a macro backdrop, growth, inflation, the path for central banks. What does that do for your equity outlook for this year?
So I could paint such a positive picture, really. There are so many positive things to say. If I was to talk about the fact that, let's start from the fact that we've been waiting for a recession for 3 years and it hasn't happened. So no one can predict anything, including the central bankers. They are data dependent. So who knows? Things can turn around. But the macro picture, the economic data, is kind of mixed in a kind of Goldilocks manner. You don't have all of the data points negative or all of the data points positive. You can pick and choose. The labor market, the most important thing, I think it's okay. I know that there is some heightened anxiety around the labor market because perhaps it hasn't been getting better, and there's some thoughts that there's some layoffs noted, and but in the U.S. the unemployment rate is 4.4%. We're higher here. Now, in terms of the other big component is earnings. Earnings growth has been better than expected every single quarter in the last 2 years almost. We're expecting this earnings growth, this quarter earnings to be 7%. Last quarter, we expected it to be 6%, and it came in at 12%. So we're expecting 7%, and we're just in the beginning, so we'll see. But if earnings hold up, and last year, 80% of the growth in the S&P was earnings, attributed to earnings, and the rest to multiple expansion. But if earnings hold up, and by the way, I would also mention tariffs. When Liberation Day happened, if I would have told you now that operating margins are at 15% highs, that margins did not get squeezed, that the consumer is spending, and that the markets are making new highs, would you say that that's expected? No. So we're on operating margins, we're at 15% highs. Companies are figuring it out, and the consumer is holding their own because they're employed. So if this maze continues in a decent fashion, we can have a good 2026.
All right, let's talk about the earnings for a moment there. I like the way that you position it, Diana. We're just getting into the first quarter of earnings season. We just had some of the banks roll out in the U.S. there. Is there any particular sectors that are likely to drive earnings surprises this quarter, and which ones would you be kind of keeping a closer eye on?
Yeah, so the earnings map by sector is favoring technology. That is where everybody is expecting, because they're coming from such a high level. Even if the growth rate is declining, it's still a big part of the whole earnings map. We had a few banks, and it's interesting how binary it was. So, the first couple of banks that reported took our market down, and today the couple of banks that reported are taking it up for the kind of the same type of reason why it was down or up, which is capital markets. Money's flowing into the market. People are investing. There is a great lubrication of capital here. But in terms of surprise, you could have decent surprise coming out of the commodity names. I know that oil, for example, is not acting, is not making any type of new high, but the companies are doing quite okay. We've had some headlines out of some gold companies. You could have a little surprise there as well in terms of the actual stock exposure.
Diana, always a pleasure chatting with you. It's been far too long. I hope we can do it again very soon on the show.
Thank you, guys. It's been a pleasure.
That was Diana Avigdor, head of trading with Barometer Capital. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Another great conversation on the show here and so many interesting things. I love the idea of the disciplined seller just because I get too emotional. I know I'm not supposed to, so that jumped up for me. But I also liked the Canada focus too, right? The outperformance of the TSX last year, energy sector, Diana's saying, has some discipline and perhaps a renewed focus on some business productivity growth in this country.
Yeah, Greg, I mean, she said it very succinctly when she was talking about how they use their tactical approach. And she is very much right. Managing the downside risk is much more difficult, obviously respecting your stop losses. So that's one thing that I'll take to heart. But just piggybacking off, the other thing that I extracted from what she was talking about was when we said, what are the sort of opportunities beyond just our borders? She was very tactical in the fact that she said, if you want to look at tech, this is the playground to play in North America, US. If you want other spaces like financial, she mentioned, Europe, their plays were sort of undervalued or might be at a more attractive valuation across the board. So it's just about finding where those different sort of opportunities are across the different areas and spectrums. And then, she rounded it off with energy, which is kind of a little bit of it's in a little bit up in the air right now. We covered oil yesterday, just talking about the Brent and crude sort of distinction prices there, but they're still being very disciplined in what she said, especially the Canadian producers, and being able to still get shareholder return, pay those dividends, manage their capex as well. But it'll be interesting to see, for us, Canada particularly, with sort of the dynamic shifting in terms of the flows, what sort of deals we can strike in terms of oil, and that is a big driver for our economy, at the end of the day there, Greg.
All right, very good stuff. These guests are so great. I guess we should thank our producer after the show for lining them all up for us. If you at home have a question for our guest or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website where you can try out the platform risk-free. You just open a practice account by clicking on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export that workspace and start trading for real. All right, we danced around some technicals in the chat there with Diana. Let's dive in for a technical take on what's happening in the markets here, and you're taking a closer look at Bitcoin.
Yeah, Greg, I mean, are we going to answer the age-old question for when it comes to Bitcoin or in crypto, and that says, is the crypto winter over now? Since we just came out of the holidays, it certainly seems like if you look at Bitcoin, remember this is the world's most traded cryptocurrency, and it surged to its highest level in more than 60 days after posting as of close yesterday, which is a 5.5% gain. Now, this has also followed moves of about 840 million in inflows in spot Bitcoin exchange traded funds or ETFs on both combined between Monday and Tuesday. Now, when you kind of peel back and you're trying to think, is this rally really, does it have the legs to sustain itself? So I kind of looked at a little bit of data and research, and we looked at, there's reports out there when you look at the blockchain and derivatives data, it does show that this rally is in fact not powered by retail leverage this time. Instead, the whales, those are ones, we call trading over $1 million, are accumulating Bitcoin on spot, while the smaller traders are still chasing the moves through futures markets. And that really means, and why this matters, is that these rallies are really led by spot buyers. They tend to last longer. The other thing I want to say, Greg, is that investor sentiment is still mixed. I mean, we've got a bit of a rally, but remember, Bitcoin's high was at 126,000 and change. So we're still 23% below, while you still have like the other commodities like gold and silver, like kind of considered the more traditional safe havens, making new record highs. So there is still a bid for more traditional safe haven assets, but we're seeing Bitcoin sort of hopefully catch up there. And the last big news that I want to mention that's kind of a big catalyst is the Digital Asset Market Clarity Act. So this is a kind of bill that's being passed through down in the U.S. It's due for a markup this week. And what that means in Capitol Hill speak is that lawmakers are finally turning drafts into something real. Now, this bill does aim to define who regulates what. It's between the SEC and the CFTC. So that will be ending years of turf wars on who takes over what areas and how crypto companies will be regulated in the future. What that means for retail traders is that there's going to be fewer rug pulls that we're going to have to deal with, better safeguards and mechanisms, and probably more legitimate exchanges that they're going to have to trade with. But let's look at the charts, because I love what's happening on the charts, Greg. We'll take a dive into it here. So I've got the daily chart pulled up. We've gone back into March. We saw kind of this big monthly rising wedge. This is mapped out on the monthly chart that I've already mapped out. One thing we know, after hitting those highs, we went into sort of a downtrend, and it wasn't able to buck. This was acting as an overhang, an upper resistance in this purple line that I've got over here. But we did finally see a break come in just at the cusp of this new year, starting to get a bit up. Key area was the demand zone at this 90 to 92,000. I'd marked this up even before it got into this level. But guess what? It actually broached this 85,000 level. And one thing, Greg, we talk about in technicals, you'll often hear me and Jason say, is that in technicals, we want to look for gaps in the charts, and gaps tend to get filled. And guess what? We had a gap going back over here just in late April. It wasn't filled on the downside, and we in fact got that fill when it did hit that trigger price, and we did see this now acting as a support level with bouncing off of that there. We've now cleared this demand zone. What is also interestingly formed, one of my kind of more bread and butter patterns that I look for is a cup and handle formation. This is a bullish sort of reversal pattern where we want to see a breakout out of that handle. It gives us a measured move, which is really aiming for this 100 to 101,000 golden mark. It is going to mark a resistance area though, Greg, so we might run into some resistance as we get to it, but there is still room for it to go. And certainly the last thing I'll confirm is I want to see the momentum. Does this really have the legs to get up to that? And certainly when you look at the RSI, it's been trending upwards, and so has the MACD. The MACD, in fact, had a bit of a cold spell after it went into the negative territory. Finally is breaking into positive territory, crossing above the zero, but also the MACD line is above the signal line, which is another bullish indicator. So it does show there's some kind of renewed interest and strength going into trying to get to that 100,000 mark there.
All right, interesting stuff there on Bitcoin. Anyone who lives in the GTA or even like Southwestern Ontario, I think you're getting hit in London too. We got a bit of a snowstorm on our hands. Last night when I got home, even before the snow started to fly, the temperature was dropping really fast. It was a stay home, Netflix and chill kind of night. That's what I did. It was a Netflix and chill night.
It certainly was, Greg, and I had to crank up the temperature in my house. I was feeling a little bit more chillier than usual. But yeah, certainly Netflix and chill, and that's what we're going to talk about next. Netflix is obviously on the docket for earnings now. They're coming out with earnings on Tuesday after the close. Remember, this is one of the world's most popular content providers. This will be the fourth quarter earnings for 2025. Consensus EPS is going to be 55 cents. on the bottom line. That marks about a 28% year-over-year growth, and on revenue, they're expecting to bring in about 11.97 billion, which is about 16.8% year-over-year. For investors, though, there's a couple of key things here. One will be the guidance that they have for 2026, especially with the U.S. markets being saturated and being more mature. So that means there's not many subscriber tailwinds in our domestic markets here. So that will mean what are they going to be talking about on the international segment and the growth there, especially India, which is a huge key market for them. The second thing that investors will probably want to sort of hone in on is any price increases in the horizon. I mean, if you're a subscriber, then you probably don't want that. But that just means if they do have price increases, the trend that they've seen is that people will go to the lower tiers or the ad tiers, which brings me to the third point is the ad revenue. That was poised to jump 100% in 2025. Its ad sales will likely continue to surge in 2026 as more of its users switch to its ad tier and Netflix starts adding more live events to its repertoire. When you talk about a valuation perspective, Greg, it's sitting at about 37.7 times on a trailing PE basis as of yesterday's closing price. This is the lowest since 2023 Netflix is at. And part of this, what's driven this, and the final thing that investors will probably want to hear, which is the big saga that's happening right now in the market, is the Warner Brothers discovery and what's unfolding there. There's a bit of a plot twist that happened. Bloomberg reported that Netflix is now preparing an all-cash deal. Now, this is important for a couple of reasons. One, for Warner Brothers shareholders, the old adage is cash is king. And this is going to eliminate any risk of Netflix sliding further before the close if they were to have a stock deal. But it also expedites the deal because it makes it less complex when you're taking out the stock portion of it. But the biggest thing that it also does is it puts a little bit of an impetus on Paramount, who now has a shorter timeline to try and convince the Warner Brothers' board, but also they won't have enough of a chance to probably mount any sort of legal action against them. So that's one to keep an eye out. I'm sure investors will want to hear that in the earnings call there. But let's look at the charts here and see what's happening. We've seen it kind of, the way I describe it is range bound or just being choppy. Like once we hit these levels between this resistance band that I've marked between 115 and 125, it kind of just stayed there for pretty much all through summer. And then coming to the close of the year in the last quarter, we started seeing a little bit of a pullback starting to take place. Maybe it was a little bit of profit taking, but we did see on that earnings report, the previous one here, we had a big gap down area that it broke below the 115 level, which now became that resistance, which was previous support over here when you look at the summer period. And then we formed this bearish channel that had formed downwards over here. Now, interestingly, I'd marked this area up, and you can see I've labeled it as a triple moving average crossover. We also have what's known as the death cross that took place here. And what this simply means is we had the 21-day cross below the 150-day moving average, but the death cross is when the 50 crosses over. Traditionally, the 200. I use the 150-day in my case when I look at the charts for a quicker reaction. We saw that. So it was squarely in bear territory at this point. We see a major supply zone at the 100 to 105,000 level here, which it also broke below. Just around December 4th when they made an announcement, Greg, typically when companies announce that they're going to be acquiring another company, you do see the stock fall, and it went from about $104 down to drop to like 90, and as of close, it's sitting at about 83 as of yesterday, or 88 as of yesterday. It's had a chance to come back. But looking at it right now, what we are trying to see is we might see some further pressure down to the 85. Earnings will be the catalyst, though, coming into Tuesday, where we could see breakout and retest that one supply. We do see the 50-day moving average being the next resistance point, just sitting below the $100 level. So that's what I want to keep an eye out on. Right now, RSI is firmly in the oversold level. It is just peeking its head above that oversold 30 level. Remember, we don't get a bullish indicator until it crosses above the 50 threshold, but it's a positive sign if it starts trending upwards there.
All right, we got a bearish channel, a bearish triple moving average crossover. You're going to walk us through a couple of ways, both bullish and bearish, that we could trade Netflix. Before you get going on that, just want to remind our viewers that options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Where do you want to start, bear or bull? You got a lot of bear stuff on that chart.
You know what? We always do with the bull. So let's flip the script today, Greg. We're going to do the bear trade here, since we're talking about the charts looking a little bit more leaning towards that. So I'm going to pull up the bearish trade. This is not a traditional bearish trade in a sense, because what I want to do is I want to take advantage of a volatility that we have coming into an earnings play. So it's what the trade trade is where one could employ is an iron condor. Again, this is more of a volatility play with a sort of bearish lean to it is how I would describe it. So we've kind of mapped out our areas where we believe there could be a support area and where the next resistance level is going to be. And based on that, going into a sort of a little bit of a 30-day time frame, looking at the February cycle, we're looking to sell basically 2 credit spreads is what this iron condor strategy is. It's made up of 4 legs of options but 2 credit spreads. So on the top side, essentially, we're looking to sell the $100 strike call to begin with, and we're looking to buy the 110 to just cap our risk on the upside there. Now, because these are both credit strategies, and iron condor is one, we're selling volatility, so we're collecting premium on this, Greg. And on the downside, similarly, we're pricing it just below that key support at 85. So if it does have a meaningful pullback, we want to eye the 80 level to sell the 80 put where we think there could be another demand zone where buyers might step in, and then make it the same distance. So we're going to buy the 70 put to protect us again on the downside in case it has an outsized move. Now, what I've also mapped out is this in these white lines are the BE stands for break-even prices. You're going to have 2 break-even levels in this trade. So our total credit that we're collecting on this trade right now, as of pricing, as of open, was $2.50. So that means on the top side, our break-even price is $102.50, and on the downside is $77.50. So what this means is this is kind of our Goldilocks zone, Greg. We want it to stay between the 80 and the 100. That means the money we collected up front, which is the $2.50, we get to keep. And I'm going to actually just pivot and say that's what our max gain is. So if it stays within our Goldilocks zone right over here, we keep the $2.50 credit that we sell on a single contract. And if it doesn't, however, and does make the bigger move, goes beyond the $102.50 or below the $77.50, we start losing on this trade over here. And the max loss is simply going to be what the spread is worth, what the spread distance is in this case, so it's $10, minus what we collected initially, which is $2.50. So we do stand to lose $7.50 on this trade. So it's an uneven skew on the risk to reward ratio point. So $750 or $750 on a single contract if it breaks below outside of our long buys, the 110 or the $70 on the downside there.
Okay, nicely laid out. Possible bear strategy. What about a bull strategy? You think maybe things are going to turn around for Netflix?
Yeah, so let's look at the bull strategy, and we're again going to play on the same theme of volatility and selling volatility. So what I've also mapped out with the bullish trade, one could employ is an uncovered put. Now, traditionally, this trade is done to collect premium, but the way I like to think of it, Greg, is when you're putting on a stock and you want to buy a stock at a lower price, you put a limit order in. This is essentially a way of tapping or trying to get the stock purchased, but with the advantage being that you get paid to do this. So the way it works is when you look at the volatility profile, it's sitting at the 51st percentile. Expected move coming into earnings is about $7.50. So I've looked at that. Remember that key support we saw on the downside, given the valuation, as selling an $85 strike put. Now, what this means is, we're obviously squarely neutral to bullish on this trade. So we expect the stock to either remain kind of as sold off as it is at the moment, or it'll go up going into this earnings print that we have over here. Now, the way the trade works is, should that not play out, so ideally we want this trade to stay out of the money to win on this trade and keep our initial credit that we sold. In this case, we're going to be selling it for $2.15 is what we're collecting. What that means is our break even, you can see that I've marked up over here, stands at 82.85. So if the stock were to go the other way and actually fall, and it breaks below this 85, we will still be okay as long as it doesn't go below 82.85. But if it breaks below 82.85, then we will start losing money on this trade. It'll go beyond. We'll basically have to spend more to buy back this option than what we sold it for. But the other big thing you have to understand, whenever you're doing a selling of an option, especially in this case because it's uncovered, you have assignment risk. And that's almost seen as a good and bad thing, because yes, you do end up winning on the trade, but you also get to, you're going to be put the stock. So we're going to end up buying the shares, 100 shares specifically on Netflix, at our strike price of $85. So again, you have to be comfortable with the strike that you've chosen, because that's the price that you'll be essentially acquiring the stock at. But essentially our break even still is at 82.85 if you consider the gain, the net credit that we took on there, Greg.
Some interesting ideas there, and both the risks and rewards for our viewers. That is all the time we have for the show this week. As always, investors should perform their own due diligence before engaging in trading. Of course, we will be back next Tuesday with the bear bull debate. And Hiran, what do we got on deck?
We got Procter & Gamble, Greg. We're doing another sort of consumer staple, I guess. So this is going to be a sort of a barometer in the sense to see how they're performing. So we haven't done that in a while. We did kind of General Mills in kind of that same space. So it'll be interesting to see what they have to say. It's undecided yet who's taking which side yet, but we'll make the big reveal on Tuesday.
Usually, as I've said before, I have visions of you and Jay meeting on the field of honor, but maybe you guys can just run your snowblowers at each other and then see who.
Yeah, I think that's the way to do it. Or we'll have a snowball fight, one or the other. We'll see who turns into their snowman, and
These
they
are
get the
all
short end of it.
great video ideas. We got to get on this.
I think
snowball fights.
there's something on socials. We got to play up this. So we'll make that happen.
Someone get a crew down there. All right, thanks, Hiran. We'll talk to you soon, and thank you to the audience for watching. We'll see you on Tuesday.